Welcome to Stock Talk with Mike. Today I'm going to talk to you about Trade Desk, ticker TTD, the self-service, cloud-based advertising platform that allows ad buyers and media campaigns to basically put out digital ads almost anywhere on the open internet. I want to talk about the upcoming earnings that they're going to be announcing on February 18th and what's in store, and a little bit of a deep dive into the company and where I see this company going in the next 5 years. If you like this kind of content, please consider subscribing to the channel, and it'd be great also if you would hit the like button on this video. One thing that's unique about Trade Desk is they're not a walled garden type advertising company. And what I mean by that is basically they give you opportunities to advertise all over the open internet, with things like connected TV, which is a huge growing industry as people continue to cut their cable, and as well as different video formats, audio ads. What else they got? They got mobile ads, native ads. So that's ads that incorporate right into websites using the same branding and themes, and also display ads. So these are more eye-catching video and banner type ads. There's a quote here from their chief marketing officer. "We never steer you towards our media assets because we don't own any. We want you to spend your ad dollars where your data leads you, that allows for transparency in everything we do." So that's quite unique when you think of another major advertising company such as Facebook, for example. When you advertise on their platform, they represent you on the buying side, but they also own the media side that you'll be advertising on. So they don't necessarily always have your best interests in mind, and they also own that data. So with Trade Desk, they expose you to the entire open internet and aren't biased towards certain media assets. So you can make sure that you're fine-tuning your advertising where it's best suited for your company and your brand. And I actually really like that they don't rely on one digital platform, say like Facebook, right? If sentiment changed and people moved away from that social media platform in the future, Facebook wouldn't have much to go on as far as advertising spend. So I like that the Trade Desk operates in all these different verticals and is completely agnostic. So one segment that's been just absolutely exploding for them is this connected TV, which grew over 100% last quarter. And also mobile video, that's up 70%, and also audio spending. So on things like Spotify, that's up over 70%. So you get a more holistic approach to your advertising through a company like Trade Desk, and you're not just looking at one granular platform, which I really like. And as a true software as a service play, that helps them demand a higher valuation than, say, another advertising company like, say, Facebook. But I just love their customer retention. It says here that they've had over 95% customer retention, so that reoccurring revenue from those customers, for the past 5 years, which is just incredible. The ad industry in general is absolutely massive, the TAM, or the total addressable market. Globally, it's a $725 billion industry, and Trade Desk still has under $1 billion in annual revenue. So it has a lot of potential runway ahead of it, especially as more and more advertising moves to digital. They also have a long history of really strong revenue growth of well over 35%. In 2020, they got a little bit of a hit with COVID-19, especially in the second quarter, where revenue actually declined year over year in that quarter. And that was as, I think, the early innings of the pandemic, when businesses just completely stopped advertising spend as they had a lot of uncertainty of what the future was going to look like and what their financial situation was going to look like. But it recovered quite well in Q3, especially on platforms like their connected televisions. And they're expecting good revenue growth again in Q4 when they report here very soon. And they're still a relatively small company in the grand scheme of things, with about a $40 billion market cap. So I could see eventually a company like this being much larger, definitely over 100 billion or even a couple hundred billion well into the future. So I think there is a long runway ahead for them for a long-term investor. But they do trade relatively expensive, like actually very expensive, not relatively, even as far as software as a service companies go, with a forward PE of 172. That's definitely on the frothy side, but it is a company that's been executing well, growing revenue growth. So that would really be the only knock on this company. The Trade Desk does report earnings on February 18th for Q4 2020, and analysts are expecting an earnings per share of $1.87. And what bodes well for the Trade Desk is actually all three previous quarters of 2020 they beat earnings per share estimates, and especially in Q3 where they destroyed earnings per share estimates. And you can see here on the Q3 report, the next day, the trade desk actually went up 29%. On the other earnings, they weren't quite as strong. They only beat by a little bit, but pretty flat for the most part. But since Q3 and the big earnings report there, they've actually traded fairly sideways. So they traded up that day to 819. Since then, they've actually traded up to well over $900 a share. Now they're about 11% off the highs, down to $864 a share. Currently, analysts have a strong buy rating on Trade Desk with a price target at 894, which is only a 3.5% upside from current share price. But I think that's a reflection of just the big run the Trade Desk has been on, that analyst price targets just can't keep up with the meteoric rise of some of these high growth stocks. Let's look at my 5-year price target for Trade Desk. So just looking first at their current financial status. So they're currently trading at $864 a share at the time of taping, and they have a market cap of just over $40 billion. Revenues in 2020 are expected to be around $732 million, with expenses of just over $590 million, which gives them net income of just over $141 million. So a profit margin of 19.3%. So I do love that they're a highly profitable company with an earnings per share of $3.01. But that they still have a staggering PE ratio of 287, even for a software as a service company. That's extremely high. But you look at their price to sales, that's in line with a lot of the non-profitable, high-flying growth stocks in the software as a service space at 55 times sales. So it is pricey, and I have brought in that valuation a little bit for my 5-year out projections, so for the beginning of 2026. So what I've used is I've assumed they continue to grow at about a 35% growth rate. I think growth at 35% currently that they saw in 2020 will actually accelerate most likely a little bit coming out of the pandemic, because they did see a bit of a slowdown in growth, especially in Q2. And I did bring in the PE quite a bit. I actually reduced it to 70, and that would most likely with this type of growth give them a forward PE of much lower in the 40 or 50 PE range. I also assumed that they will continue to improve their profit margin. Profit margin has been growing incredibly quickly, and we use that 35% growth rate, and that will project out to a $3.2 million in revenue in the end of 2025, and expenses of just over $2 million, giving them net income of $1.1 billion at a 35% profit margin. And with that PE of using a 70 PE, so I've reduced their PE substantially, right? Like if they had a similar valuation than they have today, they'd be astronomically higher target price. But this is on the conservative end, because I do think over the next 5 years, you're gonna see valuations come in. But it's not to say that some of these high-flying growth stocks can't grow into their valuation. But at the same time, being a profitable company with, very good growth rate, but not off the charts 100% type growth rate. With these kind of companies, more the 35% range. Once you get below 40, these companies do tend to get more valued based on their fundamentals, or evaluated based on their fundamentals. So valuation does become more important. But this projects out to a $1,712 price target by the end of 2025 or early 2026, which would be a 98.2% total return, which would be a 14.66% annual return. So not bad, even at the high valuation it currently gets today. I think for me personally, I would like to see a little bit more of a pullback. I don't have a position in Trade Desk, but I'm very interested in the company. I do not have much exposure to the advertising space. I would like to see it drop about 20% off the all-time highs before I opened up a position. I would say one risk, looking here, is that you look at a valuation of a company like Facebook, which also has a similar about 35% growth rate, similar profit margins as I've projected out of about 35%. And if you used their valuation metrics, which they only have a PE of about 27, that would give them a $660 share price in early 2026. So that would actually be a loss over 5 years of 23% and a negative 5% return. So I do not think they're going to be evaluated like Facebook, given that they're a true software as a service play with recurring revenue, more of like a subscription type model. But at the same time, it's something to be aware of, that valuation is what's really could play a major factor in the future share price. So just going back to using the projection, using the 70 PE ratio for 2026. If we drop the current share price to 778, so about 20% off the all-time highs, you see we start to get into a 5-year average annual return of 17%. And if we saw a drop to a share price of 700, then we get to about, using that 70 future PE, we'd be closer to about a 20% annual return. And that's kind of a good target for me. I like to think of is, the average market returns being around 10%. If we can get to about a projection of a 20% annual return, that starts to look pretty attractive to me. Trade Desk is definitely on my watch list. I think if it drops 20% off the all-time highs, I would take a small position in Trade Desk. So that'd be around just below $800 a share or so. Then I'd actually hope it'd fall closer to 700 and I would load up more. But I like to get that small position in because it's not always a given with these growth stocks that you're gonna have an opportunity. And I hate just seeing companies on my watch list that I like, good companies that I wanna be invested in for the long term, just continue to grow and I'm not participating. So what I like to do is take a small position, and then if it falls further, I'm actually excited about that. It's an opportunity to get fully invested into that company and get my position size to where I want it to be for the long term. But that's all I have for you today on Trade Desk. So thank you so much for watching. Remember to always do your own research and due diligence before making any investment decisions, and happy investing.